Learning with Dr. Shivangi. Today's topic is credit control by monetary policy. As in the previous videos, we already started the playlist for the subject business environment and also discuss various topics related to it like meaning and nature of business environment, economic policy, monetary policy and so on. So in today's video, we will discuss about the credit control by monetary policy. You can also watch other videos, links are provided in the description box. So before I started the video, I want to say you that if you like my video, please like and share this video and don't forget to subscribe my channel which is Learning with Dr. Shivangi. Now coming to the main topic which is credit control by monetary policy. So what is the credit control done by monetary policy? We'll discuss here. As per the RBI Act 1934 and Banking Regulation Act 1949, the RBI has been empowered to adopt credit control measures for proper regulation of the volume of credit, and following are the some of the measures adopted by RBI to control credit. So according to the RBI Act and the Banking Regulation Act, there are so many credit control measures are taken by the Government of India, which are as follows. First one is the bank rate, second is the open market operations, third is cash reserve ratio, and the last is selective credit control. Here cash reserve ratio is also known as CRR and selective credit control is also known as SCC. So these are the various measures adopted by the RBI, Reserve Bank of India, to credit control measure. Now we are discussing each of the point one by one in detail. So first one is the bank rate. In it, RBI, Reserve Bank of India, tries to influence the interest rate charged by the commercial banks on their leading, for example, 2% in November 1951 and 12% in October 1991 and 9% in the April 1998. So there is an increment and decrement in the rate of interest charged by the commercial banks according to the RBI. Second is the open market regulations and operations. It refers to the buying and selling securities, gold, foreign exchange by RBI to influence the cash reserve with commercial banks and thus influence the loans and credit they make to industry. So under the open market operations, RBI perform different types of functions and start selling gold, securities, foreign exchange through commercial banks to influence the cash reserve in the market. The third measure is cash reserve ratio. It is also known as CRR. The variation in the cash reserve ratio is another method of credit control pursued by the RBI. As per the RBI Act 1934, the commercial banks have to keep certain minimum cash reserves with the RBI. Accordingly, the CRR was raised from 3% in 1962 to 15% in the July 1959 and then lowered to 8% in October 1997. So cash reserve ratio is a very important method to measure the credit control performed by the RBI with the help of commercial banks. So minimum cash availability is required as per the rules of Reserve Bank of India. The next measure is selective credit control. It is also known as SCC. As per the Banking Regulation Act 1949, the RBI is empowered to control in selective manner. SCC are controls which affect a particular sector of economy. These selective credit controls may be as follows. First one is the minimum margins for lending against securities. Second is ceiling on the amount of credits for certain objectives. So according to the Banking Regulation Act 1949, RBI empowered to control in selective manner with the help of SCC which affect the economy in a large margin. Different measures used by the selective credit control, for example minimum margin for lending against security and the ceiling of the amount for credit. There are some other measures also under the selective credit control which are as follows, like charging a discriminatory rate on different loans and advances, and from 1993-94 the RBI adopted stricter SCC and stricter control have been imposed on 6 brands groups of commodities like food grain, sugar, oilseeds, cotton, vegetable oil and cotton textiles. So these are the different measures adopted by RBI for the credit control. Now again by monetary policy, now again I summarizes all the points so that you can easily understand about the topic. So what is the credit control by monetary policy? There are different measures taken by the RBI for the credit control under the RBI Act 1934 and Banking Regulation Act 1949. And the measures are as follows, which are bank rate, open market operations, cash reserve ratio and selective credit control. Under the bank rate are influenced by the RBI with the help of commercial banks, which is increases or decreases timely according to the requirement of the market. The next is the open market operations. Cash reserve is the important point for the commercial banks as well as the market. So buying and selling securities, gold, foreign exchange is done through the RBI with the help of commercial banks. Next is the cash reserve ratio. It is known as CRR. RBI decided to maintain the minimum cash in the commercial banks with the different rules and regulations. And the last one is the SCC, which is Selective Credit Control. It is also governed with the Banking Regulation Act 1949. There are different measures taken under it like minimum margins for lending, ceiling on the amount of credit, charging a discriminatory rate on loans and adopted stricter SCC. So these are the different measures of credit control under monetary policy taken by RBI. So this is all about this topic. If you have any query about this topic or if you want to know about any other topic related to research methodology, business management, business environment, you can ask me through comment box. If you like my video, please like and share this video and don't forget to subscribe my channel, which is Learning with Dr. Shivangi. We met in the next video with new topic. Thank you everyone.